Good morning, everyone, and welcome to yet another session of Bangalore Value Association.
Good morning.
It looks so good, and so we find it so exciting to come on every second Saturday and meet you all and have an exciting session on some new knowledge. And before we start to this session, I'd like to tell you about the upcoming sessions of Bangalore Value Association. The first is on 15th of November. That is with in association with ICMI Bangalore and ICMI RVO. So that will be in the ICMI chapter of Bangalore. Please, whoever are in Bangalore or nearby, please do join the event on 15th of November. After that, on 21st of November, we have our second session of the second edition of our study focus group. This time we are covering a book by Mr. Ashwath Damodaran, and the co-moderators will be Ms. Khushbu Agarwal and Ms. Shilpa Kiran. After that, on 29th of November, we are having our seminar in Thrissur, Kerala, in association with ICMI RVO, ICMI Thrissur chapter, and ICSI Thrissur chapter. I would request all of you to register for that seminar also. The flyer and all the details will be sent to you on the WhatsApp group. With this, I would ask Mr. Ravichandran to introduce today's speaker, even though I don't think so that the speaker needs any introduction.
Good morning. Yes, the speaker doesn't require any introduction. All of us are having his book, actually, a valuable book. But anyhow, as a formality, I have to introduce Harish Dhamija is a seasoned finance and governance professional with over 40 years of leadership experience and qualifications as a chartered accountant, company secretary, registered valuer, insolvency professional, and certified valuation analyst. He has extensive experience in corporate finance, valuations, M&A, and regulatory compliance area across diverse sectors and serves as a faculty with ICSI, RVO, and IACA. He has contributed to IBBA guidelines and co-authored valuation books published by Bloomsbury. We welcome you, Harish ji.
Yeah, thank you for giving me the opportunity. Today I'll be covering, the aspect, practical aspect with respect to valuation impact, the impact of, contingent liability impact on valuation. So I'll be start sharing my presentation. I have prepared some of the slides. So let me.
A small request to participants, kindly open your video. We would like to see your smiling faces. Thank you.
Yes, the screen is visible, sir? Or?
Yes, visible. Now not.
Yes, sir. It is.
Yes, sir.
Right. So we will be, touching about the liability part first. Then we will go into a contingent liability. So I'll refresh, what exactly the contingent liability when we look into any balance sheet or the financial projections. So do the warranty is a contingent liability or it is a warranty? It is a liability. So I'll start with the definition of a liability. Then we jumped into contingent liability. Then the impact, how to assess. Then we will try to cover the contingent assets. So then we'll try to compare the difference with the methodology of valuations. Basically, when we do any valuation, our prime source of information is the financial results. It may be audited balance sheet, it may be a provisional balance sheet. So the background is basically the contingent liability comes from when you prepare the accounts. When you look into the notes to the accounts, then you will find detailed on a contingent liability. the I have made the presentation in such a manner, which I have discussed in the beginning. So basically, the liability, when we talk about a liability, so it is an obligation. It is an obligation. The important is that it is a present obligation, but it relates to the past event. So any liability, any obligations which has arisen because of the past event, and we are uh, in a position to measure it reliably, then we provide in our books of accounts as a payable or a liability as a provisions. The contingent liability and the contingent assets. Let me go through the contingent liabilities. The difference, as you know, the contingent liability is, it is the possible obligation. Though it is the obligation, but it is possible, and which depends upon the occurrence of the event. May or may not happen. But such event should not be in our control, so that the uncertainty in the future is coupled with the rider, that the event should not be under our control. If I simple example we know is the case law. You have a demand, the income tax case, the GST liability, the demand notice. The simple example is the case laws. If I look into the other definition, though it is seems to be a theoretical definition, it says that the contingent liability part B, part A I have discussed, part B, it says it is a present obligation. Again, it is related to the past event, but you cannot recognize, though it is a contingent liability, because it is not probable. See the word probable. Therefore, it falls under the category of a contingent liability. In fact, when I was thinking to prepare the presentation, I thought I must add or include the real life examples. So I decided to incorporate the financials or the data from Tata Motors. The Tata Motor has been chosen because I worked with the company. We were a supplier to OEM. I worked with Minda Industries Limited for 28 years. So because of having a knowledge about OEM, I, for education purpose, I have selected a Tata Motor. So if you look into the balance sheet of any balance sheet, Tata is in front of me. The Tata balance sheet is, we have assets, we have a current assets, non-current assets. On the liability side, we have the non-current liabilities and the current liabilities. Why I am showing you? Because I will be going straightway to the provision part, this provision. This is in crores, rupees are in crores. You will find the provisions. 20,000 crores provision, more than 20,000 crore provision, non-current liability. More than 15,000 crore in a current liabilities. So it put together more than 35,000 crores are provisions. When I was going through the last presentation, which was shared, it was last, in fact, presentation. There was a discussion which was going on. The warranty is a provision or it is a contingent liability. So here, that is why I have chosen to start with the a concept with the example of with relating to provisions. If I look into the provision, before that, the the difference between the expenses is to be charged to, though I am aware that everyone is aware that there is a Ind AS 37 which talks about the provisions, the contingent liability and contingent assets. Here, I would like to refresh that whenever there is a obligation is certain, timings are certain, you can measure amount with a certain amount, then it falls under a creditors or a payable. Whenever, just think over that there is a warranty. The obligation is certain, the answer is yes. Timing is certain, warranty, can we measure reliably? Similarly, when we have a emission, yes, the obligation is certain. The obligation can be legal. It can be contractual. It can be non-contractual. The contractual means you have the agreement. Non-contractual means, say there is a customary or maybe legal obligations. So yes, the emission compliance, the obligation is yes. How to measure? Then the question comes: do we know the timings? The why I'm going through this warranty, emission, refurbishment of the buses. This I have taken from Tata. All this presentation I have tried to capture with link with the Tata refurbishment. In Tata, they have given the as per the notes, which I have gone through the balance sheet. It says Tata has given the balance the buses on a lease, and it is the responsibility of the Tata to refurbish them on a regular basis on or before the termination or a closure of the agreement. So in such case, the obligation is certain, the answer is yes. Again, these two questions, two remaining part we will discuss. Replacement of batteries. When we talk about replacement of batteries, think of ESG. We have extended responsibility, producer extended responsibility. The responsibility, the obligation, yes. Timing, battery, and then do we measure it? All the answers. If I try to give the answer is yes. Why? Look into the balance sheet of, here, product warranty is figured, emission is refurbishment, and then we have a product liability current, and so it means these are these are a part of liabilities if we are in a position to measure reliably. The standard says, even though you are not, you are not in the position to work out the timings of the liability or the provisions, they say, no, you have an obligation to quantify by using alternative methods. For example, in emission, while going through the literature globally, the standard says the emission, say it is not, you suppose you have not in a position to get the data from Indian context. They say, no, look globally. And globally, we know there's a huge data available. Try to correlate and, and put some figure. It should be real, because it is the duty of the client, as well as the duty of the auditor. Because Ind AS 37 is prepared, Ind AS is financial accounts are prepared by the management, and the auditor has to comment. You will find, I'll try to give, in the next slide, the role of a auditor also in this regard. With regard to these, parameters, we know as a valuer, we have, I mean, as a good practice which we have adopted, is to start our valuation looking into the notes to the accounts. Here you will find that the beauty, when talk about any valuations, there are few terms which, as a profession, chartered accountant plus a valuer, as a valuer, it is our responsibility to look into each and every, before raising any checklist to the client. We must, I hope everyone must be using to understanding the business. There is a study which says that 62% of the time must be spent on understanding the business of the client, or the instrument. Here, when I was going through, I correlated that there is a term called free cash flow pre-tax rate. So just keep on, when we do the valuations, the pre-tax, we will touch upon that, the of the present value aspect, when the liability is to be spread in the future. So the accounting policies, this is, talked about the recognitions of the provisions. Warranty, what exactly says, we have a past data. Warranty. Use that data, do the survey, have a proper basis. See the role of an auditor. Only in a small matter, I have touched only the warranty contract. So why I'm showing you, because when we do the valuation, we, as a checklist part, we always add the auditor's report notes to the accounts, because the auditor reports may tell you whether it is the company is a going concern or not. One of the company where we have done the valuation, it was a closed company, but it was not going to be wind up. It has a presence in India. Then we looked into the the balance sheet. I said, it's a going concern. No, the auditor said it is a not going concern. I said, what is not going concern? We have one is a going concern, another is a liquidation. So what is in between? They said, no, it is a non-going concern. You have to value. There is no concept of fair value in that case. There is no liquidation value. Here, that is, though it is a fair value based on existing condition. So therefore, I was correlating the role of the auditor's report when we do the valuation, because it talks about risk, and which is converted into discount rate, etc., etc. See the warranties. He has disclosed the group incurred a liability for warranty contract on the new vehicle. Even the auditor has given how he is convinced, how he has addressed the warranty. So we are not, before going to the promoters or a management of the company, it is already disclosed how are you, the auditor is confident about the provision on the warranty. They said, we have done so much test on a warranty. Because when we do the valuation, when we do the valuation, very simple question comes to mind. Do we work on a standalone basis, balance sheet, or a consolidated basis? Why I have chosen consolidated financials? Why not standalone? Because when you have a market multiples, it is always based on the consolidated financials. Therefore, when you do the valuations, we as a part of our checklist, we said the standalone will help us. Why, the recently we have, just maybe 10 days ago, you can search NSC, you will find the evaluation report which I have given to them. The moment the client has filed the amalgamation scheme with NSC, BSC for their observation, because a listed company, you have to take the prior approval or so-called the observation from NSC, BSC. The moment the client has filed the amalgamation scheme along with my report, they start asking the questions. Why you have not used the consolidated balance sheet? Why, from where you have taken? Because maybe 1 month ago, somewhere, in the end of October or mid of October, SEBI has issued guidelines for a listed company. And in accordance with that, NSC, BSC, they have released SOP. So they have line by line copied, the requirement issued by SEBI in their circular. In SOP, they said, there is a number of checklists, number of checkpoints. Now they have started asking why you have not applied 3 approaches, these days. So why I'm referring, because in this case, in the contingent liability, when I was going through this, presentation part on Tata, the auditor has given much coverage on their global, the company. I have forgotten what is that, JLR. I'll just again reopen my slide. So it is not a contingent liability we have to look into from Indian perspective, because it is a contingent liability on a consolidated basis, or a liability on a consolidated basis. So I'll show you again. I'll start sharing the presentation.
Vijay, can you mute the member? Anuja ji? Vijay, can you mute her? Anuja ji? Sir, I think you can continue.
अच्छा, मैं अपनी स्लाइड देख रहा हूँ कि बड़ी क्यों नहीं हो रही. You are sharing the screen. Screen नजर आ गई सर? Hello?
Yes, sir.
Okay, now see, the Tata is, the JLR group, you will find even here also they have touched upon, because of significant, the auditor might have considered, because here they are supposed to give the key audit matters, and they have touched upon the significance of the matter. So the global, I was touching about that we should work upon. We have been working, just refreshing, not Similarly, how they have calculated the methodology they have used. So it is very much clear given in the notes to the accounts. One point comes into the mind that it is a future liability. Now too, we all aware that present value is the concept. When you bring the discounting is a one of the relevant factor. And the what should be the rate of discount? Any idea? I mean, can highlight when you do the valuation and with respect to contingent liability, which rate should we apply?
Right, sir.
Neeraj, any idea? I mean, thought.
When we are doing valuation for contingent liability.
Yes, because we are aware that the liability will come, or a decommissioning or the warranty will be over a period of 8 years. 8-year figures amount is to be brought into a present value for making the provision or for arriving at a contingent liability amount. Here, the standard is very clear. It says if you start applying VAT, it has no relevance because the concept of bringing the present value for liability cannot be equity also. So it says standard is very much clear. They said whenever the contingent liability or liabilities are brought into a present value, the risk-free rate, the government bond rate, is to be applied for getting the present value of the liabilities.
And sir,
So
also
this,
because it's a liability, we have to be cautious. So when we take equity or any other risk rate, the liability will come higher, but the liability has to be recorded in the book on the cautious level because ultimately.
Yes, you're right, but the WACC will bring down that value. Suppose it is 100 crore. If you have a higher WACC, so it will be around 40 crore. If you have lower WACC,
Yeah.
it
Sorry,
will be
sorry.
80 crores.
Correct.
So it is, it is indirectly, you're very right, Neeraj, because when I was doing the valuation, I thought, here, what is, then I could looked into the international financial guidelines where it says they have given, IBS also issued, uh, discussion paper on that. So so this is very important. See, discount, risk-free rate. Liabilities included in the base calculation. Now comes the emission compliance is the obligation, liability, or a contingent liability. We have touched upon that emission compliance, in the first slide, we said the timing and the estimation is to be done, based on, past data. Technically or scientifically, you can do the evaluation of emission compliance. So how to mitigate this liability? With regard to ESG valuation, I was just touching upon in emission ground. The Tata is saying that there is a market for emission credit. You can pay, you can purchase it, or the crude is to pay fine. But the Tata said they have done the emission compliance valuation obligation by considering the purchase emission credit at market rate. So there is will, there is way. I mean, where there is will, there is way. So this they have mentioned that it's a legal obligation and they have done it. Just to, I was trying to correlate the provision for emission with the revenue. See, it has jumped. There is no formula, but they have done, rigorously. So this we just touching upon again we discussed in the beginning. Yes, the answer is in these cases. Now the question comes. I hope because I'm touching OEM, the vehicles manufacturer, there is a regulation, I think rule, sorry, the end of life of vehicle rules. These rules, the rules have brought in last year, maybe earlier they were there, they have updated. It says the old vehicles are to be scrapped over a period, and the liability has also been extended to the manufacturer of OEM. To comply this rule, there will be so many agencies involved in scrapping the vehicles, getting the certificates, segregating the reusable part or otherwise. The government has issued the rules, but the working mechanism, the appointing of authorities is in place, yet to be notified. Some of the states have gone in a different mode. So here, my discussion will be, do you think it falls under a contingent liability? In my opinion, the end of life vehicle as on date falls under a contingent liability, because we know it is an obligation. First part is obligation. Here is the obligation. The answer is yes. Timing can be in with regard to end of life of vehicle. The timing is questionable. Measurable is again questionable, because the underlying authorities or the mechanism has not been put in place. Now comes, so therefore it falls under a contingent liability. How to measure it? Now I will be touching upon that. Yes, it is important to look into the Bayer Act or standards when we have some doubts. Here it's very clear. When I started doing evaluation of a contingent liability, maybe 6 months ago, I was not clear. Then I gone into India's 37, 103 also.
Sir, I am having a question here.
Yes.
Now, so far you have explained Tata Motors saying that based on the whatever study they have done, they created a provision, short term and long term, or current or non-current provision.
Right.
When we are doing valuation,
Right.
do we need to verify that provision workings also? How did they do and apply our standard of working to re-arrive with the provisions? Can we just consider that provisions and move on?
Very right. Very valid question. Here, when it is an audited statement, when these are audited statement, we, unless and until, our role is to analyze the data, analyze the past data, and to look into that if you have a projection whether these are normalized or not. As a valuer, this is what is our practice or my practice is, if you have an audited balance sheet, detailed notes to accounts, excellent, and you have gone through that there is no abnormal variation, excellent. If there is a variation, then you will ask for the explanation, but as a practice we never ask. But again I am putting but, when we are working on a provisional statement, say audit is March, okay, is an unlisted company, so you will not get a quarterly results. So it is a somewhere in, you have doing the valuation somewhere in September or March, or other than March, other than audited. Then it is prepared by the management. Here, in such cases, we have started asking the details. Otherwise, prima facie, if there is no abnormal trend, we have been relying on the audited financials.
Okay, sir. Thank you, sir.
Right. Now, there is another, important comes when the valuer, when you look into that contingent liability, the auditor role is limited to this. See, beautiful. The auditor is supposed to make a provision when the figures are more than 50% probable. I repeat, see, create a provision. So as a valuer, I have to look into, go through, analyze. My duty is to some extent over. The valuer will come into play when the liability falls under, it is 50%, it is more than 50% here, 5 to 50% and 5%. This is not by the percentage. It has been given in the standard itself. They said if it is 5%, less than 5%, you can ignore it, because there is a concept of materiality. And then the valuer comes, because this part is shown as a contingent liability between 5 and 55%, above 55 and then 5%. Here the now already provision is there. Okay, now look into the contingent liability. Therefore, in the checklist for especially the contingent liability, we always, though it is given in the notes to the accounts, we have started asking the details from the client. Sir, please give us the breakup. Please give us the breakup. The liability, please give the table, where we can have the concept 5%, 5 to 50%, and then more than 50%. So so that we can, there is a name of the company, name of the case, what is the demand, nature of the case, where it is lying, the authority where it is lying, and what is the probability of losing the case or winning the case. Here comes very important point. Who gives this percentage? Who gives this percentage? Do we rely upon the management representation letter, or do we insist for a legal opinion? The answer is legal opinion, or opinion based on the law firm. Mind it, law firm. A chartered accountant, if he is, as a global practice, I'm telling you, globally they insist that the person who is dealing this case should not give the percentage opinion, because there may be some independence issue. Wherever the contingent liabilities are significant, it is our duty to start asking for a legal opinion from a law firm. There is one, when I was preparing this presentation, my friend suggested, he's a lawyer, and he said, though he is a company secretary also, he said, sir, there is a one case, he referred that case. I forget the name of the case. It says, in one of the case, they said the law firm which are registered in India, the opinion of those firm will be acceptable in the court of. So those companies, those firms which are not registered in India under bar council, they will not be considered as the person who can give the opinion. So here, one step ahead, we have, in our checklist, we said, okay, we will go for there is a word called tenability report or something like that. So they will, each case-wise opinion. It is not a straight way. When we have excise duty case, this much amount, one. So and try to get, what we have started getting is the judgment, the copy of the judgment, etc. And we also start doing the research if the amount is significant. Now look into the valuation standards. What exactly the standard is talking about a contingent liability. We have the ICI standard. I searched upon the word contingent liability. I can only get the answer at two places. In the whole, IVA CA standard, the contingent liability has been used when we talk about scope of work, analysis and evaluation. The financial information. Nowhere it is mentioned. I have not come across. If you have come across, please share us. I will update myself. They said under the financial information, the valuer shall obtain, where applicable and available, on the financial information on the underlying business, such as the identifiable assets, liability, contingent liability. Similarly, when I looked into IVSC, here also on that same, ground, they said contingent liability is to be deducted. See, very beautifully they have considered here also, almost on a similar line. Then I looked into, because here they are touching whenever there is a goodwill is computed. So I was surprised how to give the impact of a contingent liability other than when the matter comes on a goodwill. Then I further extended and looked into our study material issued by CA Institute. And one of the faculty has touched upon 103. Here, in the valuation standards, because it is my passion and I have been taking the session on Indes also. When you do the combination, business combination means you have acquisition. And you have acquired a company and there is a, what you call that, PP, the purchase,
Purchase
allocation
price
of, sorry?
Purchase price allocation.
Yes, purchase price allocation. In that case, PPA, purchase, मेरे को ध्यान आता है, we did the valuation of a power purchase agreement. वो PPA लिखा जाता है गलती से. Here it says when you do the allocation, in this such case, you have to do the valuation of a contingent liability. Nowhere it is mentioned in the standard. But this is an exception. In Ind AS 103, it gives 4-5 exception, which includes that you have to do the fair valuation of contingent liability. So therefore, here we can conclude, or in my opinion, in Ind AS, the contingent liability is to be, the fair valuation of contingent liability is to be done when there is a specific requirement with respect to 103. Otherwise, all the valuations are, Ind AS is fair valuation, nothing but a fair valuation. But here, the 103 specifically says that the valuation is to be done of a contingent liability. Now comes method of, now I'll be touching upon. So I have spent around 40 minutes on just having a background on contingent liability. Now another 40 minutes or 30 minutes, I will be covering the contingent liability experience on that. Mr. Rajeshwar also covered in the presentation last time. So I will be trying to add on to that. When we talk about a contingent liability, the role of probability in valuation comes. Though we know we are aware that valuation is nothing but an estimate or an opinion, but when things are uncertain, just think over when we were in 7th or 6th class, we used to do the probability. The coin is coin, head and tail, etc. Only two probability, head and tail. In business, we have various scenario. So the rule of probability comes. Probability, is a measure just to bring in the definition. Probability is a measure of likelihood of the event to occur. Many events cannot be predicted with a total certainty. So the probability is, we know that the probability, if I considered, it can be very simple. Say the coin head and tail, probability total events 2, 1 by 50% is the probability. In the complex, we have various scenario. In first part, a simple one, and the second is we will try to use some of the tools. Probability always lies between, sir,
0 and 1.
0 and 1.
0 and
1.
1. So it is always between 0 and 1. So the probability is basically, when we have a simple, we just do a multiplication. In complex, we try to use the binomial tree and Monte Carlo. The simple, is very, here the probability is 100, total is 100. 1, say there is a GST demand 955 crore. The winning chances are 30%, losing 50, full loss 20. Then these are the estimated amount. You multiply it and you get the figure. This is multiplication. Simple. So this is a simplest one when we have a probability based on a legal opinion of the law firm. When we have here, I would like to put a disclaimer. or what you call that, maybe here I am not expert in Monte Carlo. I have used this Monte Carlo in two of the assignments, and I took the assistance or the advice of my colleagues, including Sandeep Kothari. He helped me when I prepared or I conducted the evaluation by using Monte Carlo. So I'm not expert. I'll just share the manner we approached. The binomial says two. When we have two options, up and down, so we apply binomial tree. Let us look into the example. There is a level 1, the high court winning is 60%. So it means losing is 40%. If I lose, then I will go to Supreme Court. So the winning chances in the Supreme Court are 50%, 50%. Now start using the probability, not in a simple, but in a, because we have two multiples, two type of, we will lose, again we will go to that. So we will concentrate on lose, because we have to work upon contingent liability. So in this case, just recall that when we do the probability analysis, there are two type of probability. One is additive, you add it. Another is you have a multiply. Here in this case, we will multiply. For example, if this I have drawn, in this fashion, demand 40% lose, then win, high court, then lose, and then win. Because here in this case, we will be concentrating on this amount, this lose, and this lose. These are not relevant for the current purpose, the contingent liability, because we have to. So the formula will be very simple: 955 into 40% into 50%. So the answer will be, okay, here I 955. So here I'll change the figure. Sorry, 955 into 0.4 into 0.5. Okay, the figure is 191. Simple binomial. Win or lose is based on the opinion of Allah. So we have applied this red one. Now comes the Monte Carlo. Here in the Monte Carlo, we have a concept of random number generation. In Monte Carlo, I have tried to capture in 4 or 5 steps. Even there are number of mini steps also. The probability in binomial, we said up and down, 1, 2. In Monte Carlo simulation, we can have 1000 probability, 10,000 probability, random number. When you, as you know, when you put the command or a equation rand, and then you will get a random number. So in Excel, there is a command of generating the random number, Our role is to convert, to use this rand number so that we have a number of options. In my practical case, I have considered 10,000 simulation, iteration. The first step is to get, in this case, GST demand, what is probable, possible, and remote. Probable is already captured through provision. Remote is to be ignored if you consider that it is not significant, but 5% is the criteria. So the possibility. And then, the input may be the case, history, etc., etc. Random number generation. In the cases relating to the demand, it is as per the working guidelines internationally used. They said try to use this minimum, maximum, or here it is a more frequently aspect. Minimum, maximum, and then what do you think that it is occurring frequently? So it means the probability is again, is at 60% probability. To have another scenario, we can have 50% or 70%, or to have more coverage. So this, why I am touching upon, because what I have learned is in Monte Carlo or any statistics, when we talk about, there is a concept of distribution, and if the data is distributed, then they try to give the nomenclature, maybe a triangular distribution or a normal distribution. Just recall the normal distribution. A triangular is like that. Here the, because the slightly the further step will depend upon the nature of information. Then you have to apply formulas. You will come across a present value. I mean, you have to compute a present value. Why present value again? Because here, when we do the simulation, we again take that the matter will be settled in 2 years, 3 years, or 4 years, as the case may be. Therefore, present value concept will be coming when there is a period concept or a future concept. Then we have to work upon the average, median, scenario building or so. So there are, around 9 steps. Very simple, 9 steps, but I have tried to, capture in a slide, though we have a various number of independent small steps. Now, I try to show you the Excel file also, where in fact I have used. This is the input on a GST demand. They said this is the liability, the amount, and this is risk-free rate that we have touched upon. In this case, we have estimated, or the promoters or with the legal team or with the opinion of the law firm, they said, okay, it will be settled in a 3 year, 2 years. Okay. First input is about the percentage, most likely. Yes, the proper word is most likely. When we're talking about a mode, most likely. If I straightway apply 55% on this, I will get a figure of 525 as a liability. 65%, scenario building, plus 10%, minus 10%. And this, so it means these are the three figures. It will be input for my Monte Carlo. I repeat. So this figure is 9555 is there with us. Probability is with us. We have just multiplied with these three scenario. So this figure, so it means around 620 is the figure which is the most likely figure appearing as per this simple calculation. But Monte Carlo, let us see. In Monte Carlo, we have to generate, third step is random number generation. The moment you print or put this command, rand, it will give a number like that. See again here, it lies between 0 and 1. The random number 0.3, 0.59. Normally as a standard practice, we take, 10,000. Then you have to apply a what if formula. I am not going into much detail, but just to tell you that the minimum, maximum are plotted here. And by using if formula, it says whether the result is falling in this region or in this region by using if formula. So here by using 4-step, the figure arrived at, against this 620 or so, the figures is 532, 602, 582. So these figures are automatically created when we use the assumption that it is a triangular distribution. Now next come, yes, this is the Excel file which I have screenshot of that. So this is the input. First line is very important, which I have missed, 1 to 10,000. I have taken 1, add 1, drag, and then use command, go to 10,000. Or use that. Then the rand number I have discussed. Formula I have discussed. Now comes the present value. Here on the left hand side, this is the risk-free rate. 2 years. For 2 years, the discount rate is, the discount factor is 0.8829. So this is, so this I have used. And then comes a simple multiplication of this figure and this figure. So the ultimate, as per Monte Carlo, against serial number 1, the figure is 575. Point so and so. So this gives a 10,000 data. How to use that data?
Sir, I have one question here.
Yes.
Sir, how this rand, the number which is being generated, is being used in column G, the triangular,
Where? Okay, I'll just open the Excel file. Here. This.
No, the G column. Yeah, I'm talking about G column. Sir.
G
How
column.
this number?
This G column.
Yeah.
Look into that. This is the formula. Can you read out?
Yes, sir.
This formula?
Yes, sir.
So it says
F4 is okay. Is less than equal to C5. C5 is okay. Demand most likely. It's 20.
Yeah, this.
Minus C4. Okay. divided by C6 minus C4. Sir, if you can
So
explain
should I?
Yeah, yeah.
Okay. I'll just coming to that.
Yeah.
I'll open my Excel file. Okay. That will be very easy to you. So here we have to arrive at average, the median, and the percentile by using the commands. Now let us move to the, it will be very easy when we look into the Excel file. I'll coming to that, then we have a WAC rate. Okay, done. Average, mean, more median. Done. 2 years, 3 years, similarly. So I'll be using that Excel file.
Harish, sir?
Think screen not working. Some network problem.
Yes, sir. Dear participants, kindly wait. I think there is some networking issue with the speaker. We'll just wait till he resume. Anyone else would like to share any of their experiences meanwhile when the speaker resumes? Anyone has any experience with respect to contingent liabilities? Please, you can share with all of us.
Sir, it's restarting. So just wait for 1 minute. Actually.
Actually, this is very new concept. I have heard it for the first time. Valuation is very dynamic.
Yes, correct. Shilpa ji, till the time the speaker joins, can you give a 1 minute like a reference of what we are going to do in the study group?
Yeah. Actually, our initiative is to have last study focus group. We had decided that let's have a combined book study or, combined study rather of a particular book. And Khushbu, the moderator, and Neeraj, president, we all have decided that we will this time select the book of Ashwath Damodaran's book on investment valuation. It is approximately 1,500 pages, and we have decided that whoever are the participants will be volunteering to summarize one of the chapter. Say, for example, in this particular book, we have 35 chapters. So the session is scheduled in such a way that the first session we'll be taking some 5 to 6 chapters. So, for example, the first chapter, I'm the volunteer. I will have to prepare myself and then come and summarize the entire chapter 1 to the participants. And this is not a normal BVA session. This will not be in a normal BVA morning session hours. This will be, usually we have decided Friday 4 sessions, no, Neeraj? As of now, the
Yeah,
plan is 6 to 7, no?
6 to
correct. So from
7:30, I think.
To 7. 6 to 7:30. It
Yeah.
is starting from 21st November, no,
21st,
Neeraj?
right?
21st November, 28th November, then 5th December, then 4th session we will see if you are able to complete
So
the book.
Neeraj,
Then
I also want to summarize some chapters if you allow.
Okay,
definitely the
just a minute.
participation is open for all the BVA members.
Yeah,
Yes,
so
sorry,
our speaker has
I'm
joined.
reconnected.
Sure, sir.
Screen is
Yeah,
visible.
so the flyer will be out. So all of you who are interested, either reach out to me, President Pushpu, or to our admin Vijaya, and then we will resume with the current session.
Yes, sir, your screen is visible, sir.
Sir, you are muted, sir. Harish, sir. Kindly unmute, sir.
Yes. No, I have to open this Monte Carlo.
Sir, I want to understand the formula, basically.
I'm very much there, I'll tell you. Because, I don't want to go into detail. It talks about, rising, just it is there. The screen is visible.
Yes, sir.
The concept behind this is the if formula will tell you the probability by using the a minus b by divided by, the formula is there, whether that figure is coming between these three, or in fact this figure, most likely if the figure is say 620 here and it is 619, so it has to be brought down in a increasing slope. If your figure is more than that, then you please put that figure in the downward slope. So the idea is, this figure, this amount, if will tell you, just look into that. Every concept, this rand is used, this A plus B plus C is used. Madam, can you see that?
Sir, I can see. I'm just trying to find out like what is the logic of this formula.
So I'm explaining you, it says the valuation by taking these three averages, this, and that is why, we have to understand the statistics, which I have not touched. Is a normal distribution or it is a triangular distribution? If it is a triangular distribution, it means the probability is 0 to most likely, and then most likely to 0. So we can discuss later on. I mean, if you have something, I mean, a simple way to understand, or you have something, simple to explain, please let me know, because that is why when we go into a simulation, the Monte Carlo, especially these triangular formula and the simulation, I have not touched upon the formulas, which though we have a, slide for that. The point again I'm reiterating is, by using what this figure is, here it says if the working by using triangular approach, and you know what is the normal distribution, madam?
Yes, sir.
can you, are you aware or have, what is that normal distribution? So that I can explain you the difference between the triangular and the normal distribution. Here it says any data should be around mean, the average. How far it is away from the mean? When you have a, probability concept.
Yeah.
So basically,
So it is
I'm trying to figure out, but to make it more simple, I'll try to give the answer later on. But here, what I have understood is it gives the figures, say 620. If I put it here, it is covering. Similarly, if I look into the formula here, each and every parameters are covered. Okay. So now what comes? The average is there. Average, how the average will come? Average, I'll just show you. There is a simple formula. See this average formula. Not very strange. Average. Okay. Similarly, we have a median. See the median of 10,000 items. Then, in statistics, we have a concept of the accuracy level. Are we in a 5% percentile or 95% percentile? Are we covering, the huge data? Then the result will be, in this case, 686. Otherwise, average is 620. So now come to that. So we have average, we have a median, percentile, and this. And this figure is multiplied with present value factor. So this figure, and then we have taken the average median of this last column. Now comes the how to decide the final conclusion. So here I have plotted 2 years results by considering 3 years, considering 4 years. So as a valuer, which figure should I give? So this median, as a Professor Damodaran or otherwise, you will find he always educates us that we should use median. So this is the principle which we are using here also. So this median is, so it means the liability is 955. By using Monte Carlo, it is 548. And by using the simple probability, it is 491. And by using binomial, we discussed, it was 191. So this, here the matter does not end. Do you think that something is missing, madam? Even though we have done the valuation of a contingent liability by using simple, which I have given the example of a simple probability, Monte Carlo. Do you think madam, any other nature of expense is missing?
We may have to add legal expenses to fight this case, sir. That
excellent. This was the nomenclature. When I was going through the literature, they said the expenses are to be incurred in the future also for litigation. So here also the probability, and here in this case, Rajeshwar Rao, you are very right. Here what we have done is we have taken the MRL letter. I mean, here we have not gone to the legal firm. It is the promoters or the legal, their in-house consultant. They have given this figure. So otherwise we have relied upon the opinion. So this expenses plus the present value of those expenses.
Sir,
So
I have one doubt on that 5% percentile, sir. I could not follow.
Here this percentile, here This
Huh.
percentile is basically, I'll try to make it when you have the coverage, sometime you will find that the tail, this tail is abnormal. So are you looking for the data which is covering this? Normally, you have a 2 sigma is a slightly, I hope you understand, there are 2 sigma, sigma 1, sigma 2. How far this data is away from the mean? Are you covering the data with 95% accuracy? So 5% you are ignoring. How much you are ignoring? So this, the accuracy level, when you have a 5%, see the trend. The 5% is 460, average increases. The quarter 1, quarter 2, I mean the population of the data.
Sir, my basic doubt, why I got doubt is 5% percentile is coming 460, 95% is coming 516, not much difference. There I got
Yes.
confused also.
Okay. Because here we have assumed that the nature of here we have taken this much symmetry. Otherwise, in the other example, you will find that it may be skewed like that. Then this 5% rule comes.
Okay.
If the data is not uniform, then this will matter. There will be a difference. It may be 100. Because we have assumed this linear equation.
Okay, sir.
Okay. But again, I will try to look into the correct answer or a logical answer, and then we will share.
Okay, sir.
This I'm, keeping as a, additional point for me.
Sir, one more this thing, sir, before you are moving ahead.
Yes.
Sir, Excel sheet only you can open.
Okay.
Now come to that binomial tree, sir.
Yes.
Now here, like we are giving probability in case we are winning and losing. Then we are losing,
Yes.
going to Supreme Court, again probability we are giving. Someone has raised a query saying that, so we are losing, we are going to Supreme Court. Okay. If we are winning also, the opposite party is also likely to go to High Supreme Court, right? Why that probability we are not taking?
Yes. That it is called, you are very right. We have, when we clear the exam of valuation, here I have taken a simple one step binomial. There are, can you remember? There is a tree. It
Yes,
keeps on. I mean, if the other party goes, then normally in such cases, the two-way probability will not work. If it works, very fine. Otherwise, you have to again look the probability and then come back to that. So that is also possible.
possible. Okay, we can work out that probability also.
Yes, I have made it to make it very simple. In my opinion, if somebody can add to that, yes, if it is a multiple level tree, the binomial does not stop you. Binomial is you have again up and down, probability up, down, probability up and down.
So,
This can be more complex, what we learned during, but in my, for understanding purpose, when I concluded the valuation, this I kept for a sensitivity analysis.
oh, okay, sir.
Because it is covering at only two probability, two options.
Yes.
Otherwise, when I was talking about the Monte Carlo, there is this judgment in the US court. They said, why binomial you have used, why Monte Carlo you have used, why not the binomial? So I'll show you the judgment also. The point is, they said you have a large number of probability events. It will, the higher the population, higher the probability, the result will be closer to your estimate.
Okay, sir.
Any other questions? I have not gone through the question raised by the participant. Mr. Rajeshwar, can you help me?
One question, sir. One question, sir.
Any question?
One person is writing, management do not give data for contingent liability for life warranty product. How to evaluate in the absence of data of finite life? What
See, sorry. It is on warranty?
Yes, sir. Product warranty, if they don't give like lifetime warranty of product. I will repeat,
here
sir.
the
Management do not give data for contingent liability for lifetime warranty product.
okay. Here, if I look into the legal position or the legal provisions, I have referred, or we have been referring to, there is a one index, it talks about index 37. Valuer is to work upon the accounts. If the person has not given the warranty figure, if you consider it as a significant, based on the, you ask for a previous history. Okay, if it is the duty of the company as well as of the auditor to quantify that provision. If in my opinion, if for example Tata or where other companies, the huge warranty is there, you have a history. As a valuer, my duty will be to start to get the information. If not, then I have no method to quantify. I need the opinion of others. In such cases, should I qualify the report, which is not possible. As a valuer, we cannot give a qualificatory valuation. You can have a caveat limitation on performance of my duty. When you have a limited input resources, then in my opinion, the estimation, best estimation from the independent director or maybe independent body will help us. But I don't have a straightforward responsibility evasion. I cannot avoid the responsibility. So Rajeshwar, what is your views on that? Here my thought process is, if it is a significant, I will not release my report. I'll say okay, I will be unable to. If it is a significant amount, you have a history behind that. Party is not providing you the provisions figures or data. So I don't think I can have any international data.
Sir, it is my question. Can I just supplement that, please?
Yes, definitely.
Yes.
Please add.
Sir, my only short point was that in the case of a lifetime warranty, you had mentioned that we can use a risk-free rate also. Now, for that matter, in all contingent liabilities, generally we are inclined to use a risk-free rate. Though, of course, there are enough papers now to say that in the case of contingent liabilities on disputes that are in courts or otherwise, which are determined, one should basically work and veer towards WACC or cost of capital. But still, if we are using in the case of a lifetime warranty, the risk-free rate, what is the risk-free rate we use for a lifetime warranty, which is basically a product that can be 30 years, 40 years? Do we use a 10-year bond rate? Do we use what risk-free rate? Because you won't get a bond of a 50 years that is there. And more particularly now that in a competitive structure, a lot of people in the geopolitical situation are using, giving in lifetime warranty structures. How do you determine then a contingent liability on that count?
Right, sir. Adarsh, sir, here. अच्छा, आदर्श शर्मा जी, नमस्कार सर, आप मेरे गुरु हो। आप मैं अभी सॉरी, मैं आपको रिकॉग्नाइज नहीं कर पाया। ये मेरी ना, जस्ट टू टेल यू, आदर्श शर्मा जी का ना मैं नाम लिए बिना हो ही नहीं सकता। ये गुरु जी की 2 बुक्स हैं, मैंने वैल्यूएशन इन्हीं से सीखी है। पहली वैल्यूएशन मैंने 23 दिन लगाए थे, आदर्श शर्मा जी के ऑफिस गया था, तो ये मेरे को सर 95 में गुरु जी को देर लग गई सर।
नहीं सर, प्लीज।
सी ये देखिए, ये मेरी लाइब्रेरी है, सरस्वती है। सबसे पहले मैंने ये वाली आपकी जो है ना सर, ये संभाल के रखी हुई है सर। इसमें बहुत, आप गुरु हैं, मैं ट्राई टू गिव द आंसर हियर सर। वहां पे लिखा हुआ है टू कैप्चर द इन्फ्लेशन, बस एक लाइन। if I read that, it says the risk free rate just to capture the inflation factor. इससे ज्यादा सर आप ऐड करें ना।
No, sir. The point is that this is something that is becoming fluid right now, because a lot of
Very
companies
right.
are now offering lifetime warranties, long warranties, and becoming it's becoming a challenge for the valuers to actually sort of measure those contingent liabilities that are there. That is one simple thing. Also, in the case of manufacturing product, you have taken the example of Tata's and the other automobile structures. Now there is an empirical history of recall of vehicles, etc. Now,
sir.
whether those should be factored in contingent liabilities or not, that is another issue that is coming up in determination of contingent liabilities.
Right, sir.
With the risk-free rate versus the rate that is there for a walk. For example, we just mentioned that there is a court case that can be decided in 3 years. We take a tenability report; it can be decided certainly in 3 years or maybe 4 years. Now, there, why
Right.
risk-free rate? Why not walk? Because that will basically significantly alter the entire structure in that matter. Same is the case in the case of arbitration claims, where there is a tenability report. It is likely to be decided under the new arbitration rules, which has to be decided within 18 months, 1 year plus 6 months. Now there, why not walk? Why risk-free? The standard says risk-free. We are inclined basically because we don't want to violate the standard when we are actually giving a report. But the fact of the matter is that the variation because of the risk-free is to basically walk becomes so huge at times that it becomes that you are basically sort of initiating your own valuation report.
Right, sir. So I think you will be in a uh, right position to
I'm
help
just
us.
I'm just leaving that as a thought, because
Very right.
one needs to, because there are papers which are of differing opinions. Also, in the case of Monte Carlo simulation, there is a slight challenge, because in that random number distribution in case of contingent liabilities, I don't know to what extent you basically need to sort of take that distribution to hundreds or whatever. It becomes again a challenge whether to use it or not. Binomial, of course, is more precise in terms of basically determining it. And also, for example, in your case on tenability reports, you mentioned high court could be 60-40. But a lot of lawyers now veer to the fact that they don't give a tenability report saying that the probability is going to be higher in the case of a winning, because they also say that any legal process can be a 50-50 rule.
Right, sir.
So these are certain things that one will have to sort of factor as we move forward, more particularly with contingent liabilities becoming a very dominating forces in the balance sheet.
Right, sir. So just thank you, sir. Thank you.
Thank
आपने
you, sir.
सुबह
Thank
सुबह
you.
टाइम निकाला
Thank you.
here, while making the presentation, I thought I must look into some of the case law relating to contingent liability. So this case, the Vedanta Limited. In this case, what happened is a demerger case. Though it is not directly related to contingent liability, it relates to the list of creditor. One of the company, the name was appearing as a creditor in the earlier year. Subsequent year, it was shown as a contingent liability. So if the party is under a contingent liability or the name is not there, then the notice will not be sent to the creditor. So in this case, the person, there was a company, this is a case, NCLT case. One of the creditor, one of the parties, they objected. They said this 12,051 crore is outstanding under the contingent liability head. Earlier it was a liability. Though the company has shown as a contingent liability, they have not received the notice. So in this case, NCLT has said that it is not, there is a suppression of the facts and the figures. So they, in fact, so-called rejected suo motu, acted upon, and they said, okay, go for a fresh, because the material facts have not been disclosed. The valuation of contingent assets. Here I will take only 2 minutes. Basically, it says there is a one standard. Again, the Ind AS 37. It says if the contingent in the contingent assets, the virtual certainty. See, it is the reverse. Is more than 95%. Then you have to record the assets. Let us take the example of an insurance claim. Insurance claim is a receivable amount. Okay, then it says unless and until you have a virtual certainty, means the sanction letter or a letter in your hand. This is the interpretation, which I have gone through from the material issued by CA Institute. They said here as a valuer, as an accountant also, because the contingent assets on a conservative side, we have, to be very, the formula will be, if it is more than 95% certain, and that too virtual, only then it has to be accounted for in the books of accounts. In such cases, my opinion is valuer should not interfere in such cases. Just take, because already if it is across 95%, it has been captured by the, a company itself. The virtual certainty means you have a writing letter in your hand. So this is basically a liability chart, and this is the assets chart. Here it is 95, here it is 50 provision, and this notes to accounts, and then Professor Damodar also, asked for a probability weightage method. There is, globally also, there are a number of case laws. They said, okay, we are accepting Monte Carlo in place of binomial because it gives higher, range of probability. So I am done with, I have completed my presentation. So anyone would like to add? Because, मैं जो अभी बात करने लगा हूँ, ये मैंने वैल्यूएशन जो कंटीजेंट लायबिलिटी की थी, I referred our Guruji, Adarsh Sharma ji. Sir, how to start with? He said, okay, there is a tenability report. I was not aware. This all credit goes to our team. कभी राजेश्वरी से पूछ लेता हूँ, कभी संदीप कोठारी जी से. नीरज is also in our kitty. अभी करता हूँ, खोल देता हूँ. So, sir, I will request. Yes, sir. Ramesh Vijay is also there. Ramesh? Mr. Ramesh? Ramesh was our faculty when I did the value. Rajeshwar, do you remember?
I remember him, sir.
Ramesh Vijay is there. Okay, मुरली जी को तो अच्छी तरह जानते हैं हम. Shilpa, yes. Thank you for patience hearing. और किन लोगों को जानता हूँ, आई मीन बाय नेम ध्यान नहीं आ रहा. Yes, sir.
Sir, again, like this one only. Last time when I was explaining, there is a cost called insurance cost method. Anything you could find in Indian scenario.
Can you repeat?
Insurance cost method. One is
Yes,
probably.
yeah. That, I was looking for my slide also.
Sir.
In India, when I was going to the literature, in India, they have touched upon a product liability
Okay, not
for
the.
which we have insurance.
Yes, sir.
Globally also, there is a environmental protection. They have an insurance policy. In India, I can only look into that product liability insurance, which is not, because of lack of data. This insurance method is not prevalent in India, or it is not available in the literature. But globally, yes, I have seen.
Harishji, with your permission, can we launch a poll question, sir?
Yes, please.
Okay.
1 second, sir. Is it visible?
Yes, visible.
Yes, sir. Dear participants, please answer the poll one.
Just to have an idea, I mean, the very subjective and normal question. I said multiple time, once, or studied, because the literature on contingent liability is very limited, which,
Madam, next question.
Yes, sir. Sir, can you reveal the answer, sir? Harish, sir?
the answer, I mean, I think will be in front of you. I mean, here the question was, how many times you have used? I mean, what are the result? Result will be with you.
There's no
How
correct
many
answer
people
for
said?
this. Yeah, this is just a.
Yeah, yes, sir, yes, sir.
It is just a yes.
I think the answer is visible.
Nice. Oh, multiple times.
No, I think it should be more like a poll as how many people have participated and how many, what is the
how many
experience.
times I have done on contingent liability. So there cannot be any correct answer for this.
Yeah, it is just, it is an opinion. I thought
Yeah.
it is
I
not
also
a
thought
class.
it is an opinion, like whether we have done
Yeah.
it in
Let it be, practical, so that we can approach the experts.
Any other point? Yeah.
Yeah.
which
Just here, which approach do you consider most effective for valuation? There is maybe probability method, scenario, Monte Carlo, or a flat deduction. The answer, I mean, it cannot be a one answer, but the flat deduction from the enterprise value should not be the approach, but other approach are, based on data, reliability of data. I will be taking Monte Carlo. Next, madam.
Yeah.
अच्छा आप कर रहे हैं?
Wait, sir, one second.
I'm happy that there are 31 participants, including me. When the contingent assets with respect to tax refund, arbitration award, insurance claim be included in the valuation. Realization is virtually certain. Probability always include, never include until legally settled. You know, on a very conservative side,
Sir, good morning, sir. Can I
yes,
just
good
say
morning.
something? So nice.
Yes,
sir.
yes, please.
Now, this question, it is about valuation of claims or in arbitration or court cases. This prompts me to raise one question. The thing is, let me tell you, I'm apart from being a registered valuer, I'm also an arbitrator. Arbitration of both domestic and international commercial disputes. What happens
nice.
in especially in construction disputes, huge amount of stakes are involved, and the amount can be 1,000 crores, it could be 10,000 crores. But how exactly the claim has been determined? That requires some certification. What rate of interest, how you have determined risk-free rate interest, or what exactly is the how you have quantified. On that, lot of questions arise. And when the matter is before the tribunal will say you appoint an expert and let him submit a report. And they will go through the report, and then if required, they will call the valuer to give a presentation or clarify the queries. And in case there are reports, if, for example, the other party also has appointed the valuer, his report and this report both are not matching. He is telling 10,000, he is telling 5,000. Then both the parties are coming, and you wouldn't believe the arbitral tribunal will put both the people, you discuss among yourself, we will be watching the fun. And then they will come to a conclusion in arriving at who is right and who is. This is a helping method, something they find out. So this type of thing is being given, and quantum experts are there, and they are highly paid and highly recognized also. So in that connection, my question is whether any of us has got the experience of being called in question or being invited in any arbitral proceedings. Just wanted to know, because I didn't find in India this practice is there, whereas in abroad, London, Singapore, Dubai, everywhere valuers are coming in arbitration proceedings. Just wanted to know whether anyone has faced this situation where his participation was invited by an arbitral tribunal. Over to you, sir, first.
Yes, yes. Yeah, please. Over to the participants. So anyone would like to add on the point raised by or discussed by Mr. Kazi? Any experience on that? Sir, my request will be next time you take the lecture on this matter only.
Oh, nice. Thank you. It is a very interesting subject.
I will definitely, I appreciate if you can, I don't have much experience in the field of arbitration, though I know, I mean, but you are, has been handling the such cases. So my request will be that if possible, maybe next or next time, you work upon. I will also try to give the literature if available with me, so that it can be a consolidated discussion on this very. Even we would like to here request the participants on a contingent liability, the contingent assets, as rightly said, we should have start collecting the data and keep on revising, reviewing, and in the next session or in next to next session, we try to close, we should have a huge data, huge literature. Though I have collected number of research paper, I thought these were not relevant. So I have not incorporated. My suggestion to our association also, that for this specifically contingent liability and assets, if we can have a core group or something like that, it will be helpful to all the participants.
Sure, sir.
सर मैंने आपको ही काजी जी को ही कह दिया, आप ही करो.
So nice, sir. So nice. Thank you. Really, you have inspired me and you have triggered in me. Probably there will be, I will intend to make a session. I'll request BBA to give me a slot, maybe after 15 or maybe after evening, whenever that slot is. Then definitely I'll try to work on and make a presentation because this is an interesting field. I
Very
myself,
interesting, sir.
being a sole arbitrator, I was faced with a situation where the claimant is demanding something abnormal and the respondent is denying. Certain things are admissible, certain things are out of the way. Which exactly how much, if it is determined by an independent valuer, then it is always good. If I myself, just because I happen to be a registered valuer, also a sole arbitrator, if I decide, then it will be totally biased approach. That is the reason I restrain myself. So now I feel that the tribunal can appoint the experts and valuers are experts. And once it is appointed, then the valuer can come, he can submit the report as well as appear before the tribunal to give his version or ask the queries. He can be liable for cross-examination also. To that extent, that type of thing is going on in Singapore, London, and other places. So just wanted to know. So nice. Anyhow, I'll try to make it. Thank you, sir.
Yes,
Thank you.
yes.
So, Kazi sir, I have a question. In your,
Yes, ma'am.
during the course of this arbitration,
Yeah.
you said that in other geographies, the valuer will come and submit his report. My question
Very
to
right.
you is whether there will be more than one valuer who will be submitting, because at the end of the day, valuation is an art as well as a science, and it is also an opinion. So, what has been your understanding whether in other geographies, whether there are multiple valuation reports that is made available to the arbitrator for consideration, like a range is given and then the arbitrator then decides upon the value of settlement? How does that work?
Madam, the thing is, let me tell you, when the stakes involved are very little, very few, or not much, then only one single valuer report is enough. But when it is a huge amount, then both the parties, this party as well as that party, both appoint an independent arbitrator, independent valuer. Sometimes the tribunal itself, they take the lead of appointing its own valuer. So all the possibilities are there, depending upon, because it runs into millions or millions of dollars. So that type of situation takes place when the amount involved in the arbitration case is very huge. So there is no specific formula. If the amount involved is less, then only one single arbitrator, a single valuer is there. Thank you, madam. This is what I just wanted to share.
Thank you, sir. The whole thought process was, see, at the end of the day, there is an appellant's value and there is a respondent's value, right? So
yeah, we can have these questions, madam. Now I should not encroach upon the time of Mr. Dhamija. These things we can discuss
No.
the next.
It is, I'm also, getting, no.
The only point that I wanted to make, Dhamija sir, was, at the end of the day, it is the arbitrator's job to award a fair value. So, if in the event there are more than two, the appellant also appoints a valuer and respondent also appoints a valuer, then it will be for the arbitrator to decide what is a fair value, taking into consideration and considering the fact that arbitrator himself is also a valuer. He will be in a better position to study the valuation report submitted by both sides, the valuers from both sides, and then take a call and ensure that a fair value is determined and awarded to the to the appellant. Thank you so much, sir.
Okay. So nice, so nice. Thank you. Anyhow, what I said, once again, I'll repeat. When the amount involved is huge, there can be 2 or 3 experts appointed, one by party, another by respondent, another by the tribunal itself. And sometimes it will be a good fun. There will be big crossfires between all these 3. If there are huge contradictions between the reports, then the tribunal will watch for the discussions taking place between these, and then they will determine who is right. That it all comes from the examination, cross-examination process. Thank you.
Noted, sir.
Yeah, thank you.
In IBC, we have heard about, valuer, second valuer, third valuer, if there is a significant difference.
Yeah.
Right. Thank you, sir.
Yeah.
I think we are just completing our session on time. We started at time. We started on time, and we are hopeful. Thank you for the participation. And next time we will try to incorporate much more data. Thank you for inviting me.
Thanks, sir. Probably we will have a session on binomial tree and Monte Carlo simulation.
Yeah, in fact, I am also at a learning stage. Yes, you are right. Mr. Kaji will add on. And those who are, my request will be, those who have handled the binomial and Monte Carlo in a complex situation.
Correct.
They can also come forward to guide us.
Guide us, sure.
Okay, sir. Now, we came to end of the session. It is our obligation to say thanks to Mr. Harish Dhamija. And you'll be surprised, he is 68, completed 68 and entered 69. Still, he's having that zeal to learn the new things, to handhold youngsters, and to spread the knowledge among the valuer community. We are obliged, sir. Your concepts enlighten all the valuers here to take up contingent liabilities valuations. Otherwise, they're doing valuations to read the accounting policies and concentrate on provisions where this kind of contingent liabilities provided or provision, or look at contingent assets also when they're doing valuations. Given much depth into the subject, on behalf of BVA, we thank you for your time and efforts you put into present the case to all the respected members, sir. Thank you and have a good day.
Thank you.
Thanks a lot, sir. Thanks a lot.
Thank you, sir.
Sir, on token of appreciation, we will send you a memento. After that, I will reach you regarding your address, sir. Thank you. Thank you.
Right.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Deep respect, sir. Dhamija, sir, thank you so much for your time and guidance.
Thank you, Ji.
Thank you, everyone.
Right.
Have a nice weekend.